Imagine two giants standing in the same storm. One is building a concrete bunker, while the other is trying to patch a leaking umbrella with duct tape. Today, at HDIN Research, we are dissecting the 2026 strategic audit of A.O. Smith and Whirlpool. It's a story of margin integrity versus structural survival. By the end of this video, you'll know why one is a compounder and the other is a transformation gamble. Let's look at A.O. Smith. We call them the Fortress. Why? Because when your water heater breaks at 2 a.m., you don't check the interest rates or the stock market. You just buy a new one. This replacement necessity gives them a massive 38.8% gross margin. They convert 100% of their earnings into cold, hard cash. In a volatile 2026, AOS isn't just a stock, it's an insurance policy for your portfolio. Now, let's talk about Whirlpool. It's been a rough ride. Their credit rating just hit junk status. Imagine your credit card getting declined at a high-stakes poker table. That's where Whirlpool is. They've slashed dividends and cut buybacks to zero. They aren't just fighting competitors, they are fighting a mountain of debt and a cooling housing market. The summary is simple. It's a K-shaped recovery. AOS is riding the wave of new efficiency regulations, while Whirlpool is desperately selling off its international branches, like EMEA and India, to focus on the Americas. One is playing offense with a strategic alpha, the other is playing defense with a portfolio rebirth. Look at this radar chart. It's a massacre. AOS leads in almost every category: pricing power, cash flow, you name it. Whirlpool's only win? Operational resilience. They make almost everything locally in the US. That's their shield against trade wars, but is it enough to fix their leaking margins? Where is the money going? Whirlpool's margins are leaking like a rusty pipe. A mix of bad product strategy and rising steel costs has dragged their EBIT down to 4.9%. In the world of MBB consulting, we call this margin erosion. In plain English, they are working harder for less money. 2026 is a race against the clock. By October, new government efficiency rules kick in. This is the golden deadline for AOS. They've been buying companies like Leonard Valve to prepare. Meanwhile, Whirlpool is busy selling their India stake. While one buys the future, the other sells the past. Size isn't everything. Whirlpool is huge. A massive bubble on this map, but they are sinking toward the bottom of the margin scale. AOS is smaller, but they sit in the niche alpha zone. They don't need to sell more than everyone, they just need to make more on every sale. China used to be the engine of growth. Now, it's an emergency brake. AOS sales in China dropped 12%. They have 4,200 employees there, and they are now assessing the business. That's consultant speak for, we might be leaving. If AOS exits China, it's the end of an era. Usually, we hate government red tape, but for AOS, the 2026 DOE regulation is a gift from heaven. It forces commercial buildings to buy the high-end tech that only AOS really dominates. It's a non-discretionary volume spike. In 2026, Uncle Sam is AOS's best salesman. This table tells the whole story. AOS is a dividend aristocrat, buying back $400 million in shares. Whirlpool? They just cut their dividend by nearly 50% and stopped buybacks completely. It's the difference between a company that has surplus grain and one that's rationing its last loaf of bread. Even in ESG, the strategies differ. AOS focuses on electrification, making products that survive gas bans. Whirlpool is focusing on net zero manufacturing. One is trying to make a cleaner product, the other is trying to run a cleaner factory. Both are vital, but only one drives immediate sales. Here is the hidden danger, the tariff trap. Competitors are preloading a year's worth of inventory before tariffs hit, which kills Whirlpool's ability to raise prices. They are stuck in a pincer movement between high US steel costs and aggressive foreign inventory. AI isn't just for Silicon Valley, it's for water heaters too. AOS is using AI to predict when a boiler will fail before it actually does, creating a service moat. Whirlpool is using AI to sell directly to you, bypassing the retailers who eat their margins. While Whirlpool is selling its India stake to pay off debt, AOS is doubling down with the Pureit acquisition. India is the new battleground. While one giant retreats to the US, the other is planting its flag in the fastest-growing market in the world. Whirlpool's last stand is its factories. 80% of what they sell here, they make here. In a world of global trade friction, being local is a massive luxury. It's their ultimate hedge, but they need to turn that operational strength into actual profit, and fast. Here's our final HDIN research verdict for 2026. AOS is a buy, It's a high-quality compounder with a regulatory tailwind. Whirlpool is a hold. The upside is huge if they survive, but the execution risk is extreme. Don't buy the brand, buy the balance sheet. Thanks for watching this deep dive. For the full 100-page market research report on industrial durables, visit us at HDINresearch.com or email our sales team. Let's navigate the 2026 markets together.